Namaskar, dear learners. My name is Chainika Senapati, and I welcome you back to the week 6 on the module Cooperatives and Rural Development. So, dear learners, in the previous video session, we explored the historical evolution and philosophical foundations of the cooperative movement in India. Building upon this foundation, this video session delves into the diverse forms that cooperatives have taken in India. So, understanding these various forms is essential, and they have evolved to address different sectoral needs from agriculture and dairy to housing and credit. Each form has unique characteristic, governance structures, and operational models tailored to specific economic activities and member requirements. So, dear learners, let us now see some of the aspects related to the forms of cooperatives. India has one of the largest cooperative movements in the world, with over 850,000 cooperative societies covering virtually every sector of the economy. The forms of cooperatives in India can be broadly categorized based on their functional areas like agricultural cooperatives, including farmer producer organizations, we call it FPOs, and the farmer producer companies, we call it FPCS. Credit cooperatives, consumer cooperatives, then various other specialized forms. So each type serves distinct purpose and operates under different regulatory frameworks. Though all share the fundamental cooperative principles of democratic governance and member ownership and equitable benefit distribution. Dear learners, in recent years, the Government of India has introduced new institutional forms, like I have said, FPOs and FPCs, to address the limitations of traditional cooperatives and provide farmers with greater market access, better bargaining power, and improve economic returns. And these hybrid models combined the collective strength of cooperatives with the operational flexibility of companies, representing an evolution in India's cooperative thought. So, this video session provides a comprehensive overview of the major forms of cooperatives operating in India today, examining their structure, their functions, legal frameworks, then strengths and challenges. And by understanding these diverse forms, you all will appreciate how cooperatives have been adapted to serve different sectors and how they continue to evolve in response to changing economic conditions. So, dear learners, after going through this video session, you will be able to identify and differentiate between the major forms of cooperative operating in India, including the agriculture cooperatives, then credit cooperatives, consumer cooperatives, and some specialized forms. You'll be able to analyze the structure, the mechanisms, and the operational models of farmer producer organizations, FPOs, and farmer producer companies, FPCs. You'll be able to evaluate the strength and the limitations of different cooperative forms. You'll be able to compare the traditional cooperative societies with newer institutional forms. Then we'll be able to explain the legal and the regulatory framework governing different types of cooperatives in India. And you'll be able to assess the role of various cooperatives form in promoting rural development, financial inclusion, and economic empowerment. And you'll be able to apply knowledge of cooperative forms to identify appropriate institutional structures for different contexts and member needs. So let us now discuss the agricultural cooperatives. So, agricultural cooperatives form the backbone of India's cooperative movement, serving millions of farmers across the country. These cooperatives emerged primarily to address the challenges faced by small and marginal farmers, including limited access to credit, then inputs, markets, and technology. Agricultural cooperatives in India can be categorized into several types based on their primary function. That first is the credit provision, then input supply, then marketing, processing, then integrated services. So the structure typically follows a three-tier system at the village, district, and the state level. This we have discussed in our previous videos also, though some variations exist across the states. And the primary cooperative society operates at the village level. The district central cooperative society coordinates activities at the district level, and the state cooperative federation provides apex level coordination and support. Then let us now discuss the primary agricultural credit societies. Actually, it represents the grassroots level of the rural credit structure in India. And primary agricultural credit societies, PACS, are village level cooperative credit societies that provide short term as well as medium term loans to farmers for agricultural and elite activities. PACS plays a crucial role in rural financial inclusion by providing accessible credit to small farmers who often lack collateral or credit history. They offer loans at a reasonable interest rates for various agricultural purposes, including crop production, then purchase of inputs like seeds, fertilizers, and investment in farm equipments. And beyond credit, many PACS have diversified into input supply, then organizing procurement and providing extension services. Now, let us discuss about the marketing cooperatives. It helps actually farmers collectively market their produce, then thereby reducing dependence on intermediaries, obtaining better prices, and reducing post-harvest losses. And these cooperatives purchase agricultural produce directly from the member farmers, undertake processing and storage, and sell to a bulk buyer or in retail market. By aggregating produce, marketing cooperatives enable farmers to access larger market and negotiable better terms. And the structure of the marketing cooperatives actually typically mirrors the three-tier system. Primary marketing societies operate at the village or the block level. District marketing federations coordinate activities across primary societies, and state marketing federations, we often call it as state agriculture marketing boards, provide apex level support and market access. And some cooperatives also operate retail outlets to directly reach the customers. Some notable examples of successful marketing cooperatives include the National Agricultural Cooperative Marketing Federation (NAFED), which operates at the national level, procuring and marketing various agricultural commodities, and state level federations like HOPCOMS and in Karnataka and Markfed in several states. This we have already discussed in our previous videos, and these organizations have help farmers secure remunerative prices and reduce their vulnerability to market fluctuations. The development of electronic national agriculture market (ENAM) and reforms in agriculture marketing laws are creating new opportunities and challenges for marketing cooperatives. Now, let us discuss the processing cooperatives. So, processing cooperatives add value to agricultural produce through processing, grading, packaging, and branding their activities. This cooperative enables farmers to capture a large share of the consumer price by moving up the value chain. Processing can range from simple activities like cleaning and grading to sophisticated industrial processing. We know the dairy cooperatives represents the most successful example of processing cooperatives in India. We already discussed it. For example, Amul model, becoming internationally recognized. The Gujarat Cooperative Milk Marketing Federation, which markets products under Amul brand, exemplifies how processing cooperatives can transform an entire sector. Now, let us discuss about the input supply cooperatives. So, input supply cooperatives provide farmers with timely access to quality agriculture inputs like seeds, fertilizers, pesticides, and farm equipment at a reasonable price. By purchasing inputs in bulk, these cooperatives achieve economies of scale and pass savings to members. They also help prevent exploitation by input dealers and ensure availability during peak seasons. And these cooperatives operate through a network of distribution centers, typically following the three-tier structure again. The Indian Farmers Fertilizers Cooperative IFFCO and Krishak Bharati Cooperative, we call it KRIBHCO, are prominent examples at the national level, manufacturing and distributing fertilizers through an extensive cooperative network. State level input supply cooperative complement these national organizations, and an input supply cooperatives often integrate credit facilities, then allowing farmers to purchase inputs and credit terms. Now, dear learners, let us discuss about the farmer producer organizations, that we call it FPOs. So FPOs, farmer producer organizations, represent a relatively new institutional form designed to enhance collective action among farmers while addressing some limitations of traditional cooperatives. FPOs are legal entities formed by primary producers, namely farmers, with the objective of improving their income through aggregation of produce, collective bargaining, accessing the market, reducing cost of inputs, and achieving economies of scale. And the rationale for promoting FPOs emerged from recognizing several challenges. Traditional cooperatives, despite their achievements, often suffered from governance issues, political interference, limited market orientations, and inadequate professional management. Additionally, the small size of land holding in India makes individual farming uneconomic. FPOs seek to combine the collective strength of cooperative with greater operational flexibility and market responsiveness. The Government of India has actively promoted FPOs formation through various schemes. The Ministry of Agriculture launched a program in 2011 to create 2000 FPOs, later expanded significantly. NABARD, then Small Farmers Agribusiness Consortium, and the state governments support FPOs formation through financial assistance, capacity building, and handholding support. At the recent estimate, over 10,000 FPOs have been formed across India, though their functionality and success vary considerably. And the FPOs typically consist of small and marginal farmers organized at the village or the cluster level. Membership ranges from a few as 100 farmers to several thousands. So, though an optimal size of maybe 500 to 1000 members is often recommended for viability. And the FPOs conduct regular general meetings where all the members participate in major decision, review their performances, and elect directors. So, what are the functions and the activities of FPOs? So, dear learners, FPOs undertake diverse activities aimed at enhancing farmer income and reducing cost. Input aggregation and supply is often the entry point, allowing FPOs to purchase seeds, fertilizers, and other inputs in bulk at lower price and supply to members with small margins. This service builds trust and generates immediate benefits for members. Produce aggregation, then marketing forms the core activity of the most FPOs. By collecting produce from individual farmers, FPOs create marketable surpluses that attract bulk buyers. This aggregation enables better price negotiation, reduces the transaction cost, and provides access to organized markets. Some FPOs have established direct linkages with the retailers, processors, and exporters also. And the credit facilitation is another important function. FPOs help members access institutional credit by acting as facilitating agent, providing documentation support, and sometimes by directly borrowing from the financial institutions and on lending to the members. And some FPOs maintain revolving funds for providing short-term credits. The extension and technical services provided by the FPOs include the training on improved agricultural practices, then facilitating access to technology, then organizing demonstration plots, and connecting farmers with agricultural universities and research institutions also. And these services enhance productivity and promote sustainable farming practices. Dear learners, there are some advantages and also some challenges of FPOs. So, FPOs offer several advantages over the traditional institutional forms. They provide greater operational flexibility and market responsiveness compared to conventional cooperatives. The company structure enables easier access to institutional finance, as banks are more familiar with the company regulations, and FPOs can enter into commercial contracts, attract private investment, and scale up operations more efficiently. Professional management combined with member ownership creates a balanced governance model. These members control strategic decisions. Professional CEOs bring business acumen and market knowledge. This structure reduces some governance problem common in the traditional we see in the traditional cooperatives while maintaining member centrally. FPOs actually facilitate market linkages more effectively by aggregating produce to meet bulk buyers' requirement, then maintaining equality standards and ensuring timely supply. They can negotiate contracts, participate in organized markets, and even export produce. And this market access translates into better price for farmer members. However, FPOs face significant challenges. Capital adequacy remains a major constraint, as small farmers' contributions are limited and access institutional credit requires time and established track records. Many FPOs depends heavily on government grants during initial years, and sustainability after grant support ends is challenging. Professional management recruitments and retention is difficult due to limited capacity to pay competitive salaries, and particularly in remote locations, and finding managers who combine business skills with social commitments and willingness to work in rural area is very challenging. So, let us now discuss the farmer producer companies, FPCs. So FPCs are specific form of FPO registered under the Companies Act as producer companies. The producer company concept was introduced through the Companies Amendment Act 1956, which added a new chapter Part 9A specifically for companies formed by producers for mutual benefit. This legal framework has been carried forward in the Companies Act 2013 under Section 378 to 386. The producer company framework combines elements of cooperative societies and private companies. And like cooperatives, producer companies are based on principle of mutual assistance, member control, and equitable distribution of benefits. Like private companies, they have legal personality, can enter contracts, own property, sue and be sued, and have clear corporate governance structures. To register as a producer company, there must be at least 10 individuals, each being a producer, a farmer, or two or more producer institution, or a combination of individuals and producer institutions. When we say the word producer, it must form a part of the company name. And the object of the producer company must be limited to activities specified in the Act, which include production, harvesting, procurement, grading, pulling, handling, marketing, selling, and export of primary produce of the members, or import of goods for their benefit. The structure of an FPC includes the general body comprising all the shareholders that are the farmers, a board of directors elected by the shareholders, minimum of 5 directors and maximum of 15, and professional management led by the chief executive. The board meets regularly to oversee the company's operation, while the general body meets at least once annually to approve financial statements, elect directors, and make major policy decisions. So let us now discuss some of the distinguishing features of FPCs. FPCs have several distinctive features that differentiate them from both traditional cooperatives and regular private companies. Membership is restricted to producers, ensuring that control remains with farmers. Unlike cooperatives, which often have nominal membership fees, FPCs require share capital contribution from members, creating ownership stakes proportionate to shareholding. Voting rights in FPCs generally follow the one member, one vote principle and similar to cooperatives and unlike regular companies where votes are proportional to shareholdings. So, profit distribution in FPCs must prioritize patronage rather than capital contribution. A significant portion of profits is distributed a bonus based on the extent of participation in the company's business rather than purely on share ownership. The regulatory framework of FPCs under the Companies Act provide a greater clarity and familiarity for financial institutions, facilitating easier access to credit and investment compared to cooperatives registered under state cooperative laws. Banks and investors are more comfortable with company structures, auditing requirements, and insolvency producers. FPCs can mobilize share capital from member and even from non-members, providing greater financial flexibility. They can issue different classes of shares and even raise debt capital more easily than cooperatives. Now, dear learners, let us see how FPCs are different from the traditional cooperatives. So, understanding the difference between FPCs and the traditional cooperatives helps actually appreciate why the FPCs model has been promoted extensively in recent years. The traditional cooperatives are registered under State Cooperative Societies Acts, which vary across states and are often outdated. FPCs follow the Uniform Companies Act applicable across India, providing consistency and clarity. The governance structure differs significantly. Cooperatives often have complex multi-tier structures with apex federations controlling primary societies, and FPCs operate independently with direct member control, though they can collaborate with other FPCs also, and this autonomy enables quicker decision making and greater accountability. Political interference has been a persistent problem in cooperatives, with elections often becoming politicized and management decisions influenced by political considerations. So, FPCs being registered as companies, they relatively better insulation from direct political control, though they are not entirely immune. And capital mobilization is much easier in FPCs, while cooperatives rely primarily on member contribution and government support. FPCs can issue shares, raise commercial borrowings, and even attract equity investment from institutions. And this financial flexibility enables faster growth and better infrastructure development. The tax treatment is an important consideration. Producer companies registered under Section 581A were initially exempted from the certain tax provisions applicable to regular companies. While tax laws have evolved, FPCs still enjoy some beneficial provisions. So, both cooperatives and FPCs can access concessional credit and government support schemes. However, cooperatives have advantages too. They have a longer history and established networks, particularly in credit and dairy sectors. Some state cooperatives departments provide extensive support to cooperatives. The cooperative brand has social recognition and trust in many communities. And furthermore, cooperatives' principles of one member, one vote, and prohibition of profit distribution beyond limits are more strictly enforced than in FPCs. Now, dear learners, let us discuss some of the success stories and some lessons. So, several FPCs across India demonstrated significant impact, providing valuable lessons for replication. The Sahyadri Farms FPC in Maharashtra, dealing in fruits and vegetables, has achieved remarkable success by establishing stringent quality standards, building strong market linkages with retail chains, and investing in cold chain infrastructure. In Madhya Pradesh, several FPCs dealing in pulses and oilseeds have successfully aggregated small farmer produce, accessed minimum support price MSP, procurement system, and negotiated with food processing companies. Coffee and spice FPCs in Karnataka and Kerala have leveraged collective marketing to access export markets, demonstrating that FPCs can facilitate international trade for small producers also. Building trust through transparency, regular communication, quick demonstration of tangible benefits to member is essential, and successful FPCs invest in member education and create opportunities for member participation beyond formal meetings. Market linkages must be established before scaling up aggregation to avoid situations where FPCs collect produce without assured outlets. However, many FPCs struggle with sustainability challenges also. Dependence on grant support without developing, viable business models leaves FPCs vulnerable when grants end, and inadequate working capital hampers trading operations. Then competition from established traders who can offer cash payments immediately is very difficult to counter. So these challenges underscore a need for continued hand-holding support, capacity building, and patient capital during the established phase of FPCs. Now, let us discuss the credit cooperatives. The rural credit cooperative structure in India follows a three-tier system designed to provide credit from the village level to the state level. This structure ensures financial intermediation, risk distribution, and coordination across different levels. At the base are primary agricultural credit societies, which was discussed earlier, operating at the village level and providing direct credit to farmer members. The intermediate tier consists of district central cooperative banks, also called district cooperative central banks, and there are about 370 DCCBs across India, typically one per district, though some districts have multiple DCCBs. And these banks coordinate PACS activities, provide refinance to PACS for lending to farmers, mobilize deposits from the public, and conduct banking operations. At the apex of the rural credit structure are the state cooperative banks, one in each state or union territory, totaling about 33 across India. This three-tier structure creates a financial pyramid where funds flow downwards from NABARD through standard CBs and DCCBs to PSCs and ultimately to farmer borrowers. Now, let us discuss about the urban cooperative banks. It serves the urban and the semi-urban populations, providing banking services primarily to middle and lower middle income groups, small businesses, and retail traders. UCBs are classified into two categories. Tier 1 banks have deposited less than rupees 100 crores, while Tier 2 banks exceeds this threshold. Scheduled UCBs have higher regulatory standards and access to RBI refinance facilities also. The organization structure of UCBs resembles the traditional cooperatives with membership open to residents of the area of operation. Historically, UCBs played a very vital role in urban financial inclusion, particularly for communities like the Lohana community in Gujarat or Marwari community in Rajasthan, where trust-based lending within community networks enable credit access. Many UCBs financed small business traders and self-employed individuals who lacked access to formal banking. Now let us discuss about the thrift and the credit cooperatives. So thrift and the credit cooperatives, also known as the savings and the credit cooperatives, are member-owned financial cooperatives focused on mobilizing savings from members and providing small loans for various purposes. These cooperatives particularly serve low-income populations, women, and vulnerable groups who may lack access to formal banking services. The thrift cooperative model emphasizes savings mobilization, with members regularly contributing to their savings account. And the self-help groups, SHG's Bank Linkages Program, represents a highly successful thrift and credit cooperative model in India. Mutually aided cooperative societies, MACs, in some states operate as thrift cooperatives with greater autonomy than societies registered under the State Cooperatives Act. And MACs are registered under special legislation in the states like Andhra Pradesh, Telangana, and Karnataka, providing them independence from government control and cooperative departments. Thrift cooperatives face many challenges, including limited capital-based restricting loan sizes, dependency on external credit linkages for scaling up, then governance issues, particularly in managing group dynamics and ensuring repayment discipline. Despite these challenges, thrift cooperatives remain relevant for promoting financial inclusion, building saving habits among low-income populations, providing access credit, and creating social capital through collective action. So there are some consumer cooperatives also. So these are retail organizations owned and operated by consumers themselves to purchase goods collectively and distribute them at a fair prices. The primary objective is to eliminate middlemen, reduce cost, and provide quality products to members. And the consumer cooperatives have a long history in India, with the first registered in Bellary, Karnataka in the year 1904. The consumer cooperatives operate stores selling groceries, then household goods, consumer durables, and other products. Then the National Cooperative Consumer Federation coordinates these consumer cooperative activities at the national level. State consumer cooperatives federations exist in the most states and district, and primary consumer cooperatives operates at the lower level. Historically, consumer cooperatives played an important role in making essential commodities available during the shortages and keeping prices in check. However, consumer cooperatives have declined in many areas due to competition from the organized retail chains, supermarkets, and e-commerce platforms, which offer wider choice, better shopping experience, and competitive prices. There are certain other specialized cooperative forms also. So beyond the major categories that we discuss, India has diverse specialized cooperative forms serving specific sectors and needs, like dairy cooperatives, fisheries cooperatives, handloom and handicraft cooperatives, labor cooperatives, then multi-purpose cooperative, transport cooperatives, educational cooperatives, and health cooperatives. These all we have discussed in our previous video, and the diversity of these cooperative forms in India demonstrate the adaptability of cooperative principles across sectors. Each form addresses specific needs while maintaining the core values of member ownership, democratic governance, and mutual benefit. When we talk about the emerging trends and innovation, the cooperative landscape in India is evolving with several emerging trends shaping future directions. Digital technology adoption is transforming cooperative operations across sectors. Mobile applications enable members to check accounts, place orders, and receive informations. The digital payment system facilitate transparent transactions, and some cooperatives use blockchain for supply chain traceability, and computerization of PSCs under various government schemes improve financial management and service delivery. The public-private partnership are emerging as cooperatives collaborate with the private companies for technology access, market linkage, and capital. Corporate social responsibility programs of companies increasingly partner with cooperatives for rural development initiatives. While such partnership must preserve cooperative autonomy and member interest, they can accelerate growth and modernization. Focus on organic and sustainable agriculture aligns well with the cooperative principles. Many FPOs are organizing farmers and organic farming, accessing premium markets, and promoting environmental sustainability. Women cooperatives are receiving increased attention and support, while dairy cooperatives have long involved women significantly. FPOs exclusively for women farmers are being promoted. Women credit cooperatives and SHGs have demonstrated strong repayment records and social impact. Gender-responsive cooperative development represents both social justice and sound business practice. So, dear learners, in this video session, We explored the diverse forms of cooperative operating in India, each serving distinct purpose while sharing fundamental cooperative principles. We examine how cooperatives have evolved from traditional forms to newer organization structures like FPOs and FPCs that addresses contemporary challenges while building on cooperative foundations. Agriculture cooperative, including PSCs, marketing cooperatives, processing cooperatives, and input supply cooperatives, form the backbone of rural cooperative infrastructure. And these organizations provide farmers access to credit, input, markets, and value addition opportunities. While traditional agriculture cooperatives have achieved significant successes, particularly in dairy through the Amul model, and many face governance, financial, and competitive challenges also. Great cooperatives maintain extensive rural and urban reach, providing financial inclusion to population undeserved by the commercial banks. Consumer cooperatives, while facing competitive pressures from the private markets, continue serving important functions. Specialized cooperatives in sectors like dairy, fisheries, handicrafts, transports, then healthcare demonstrate the adaptability of cooperative principles across diverse economic activities. So, understanding these diverse cooperative forms enables appropriate institutional design for different contexts, informed policy making, and effective implementation of cooperative development programs. Cooperatives remain vital institutions for inclusive economic development in India, continually evolving to address contemporary challenges while maintaining their fundamental values. So, dear learners, with this we have come to the end of this video session. Hope to see you in the next video. Until then, keep learning.